All right. Well, welcome everyone. I am super excited to kick off this top performer webinar with Aspen. Just to give you some background, we founded Vyzer with an objective to help people track and manage their wealth, especially around the more complicated types of investments in the private markets. And since we launched Vyzer 2 years ago, we've helped thousands of families track almost $18 billion of assets, the vast majority in the private markets. And throughout this whole process, people have asked us if we have insight into who the best operators were in their respective markets. And so we decided that we're at this point that we can, confidently say, based on the huge aggregated anonymous data set of investments, who these operators are. And based on that, we started to bring them to the table to talk about their deals. And Aspen, regardless of the fact that I know these guys personally, both Ben and Bob are great people. They've been on our top performer list, and we have about $11.5 million invested with them, 50 different investors. So there's a lot of really credible data supporting that you guys are good, at least historically. And so I reach out to Ben and say, hey, listen, why don't we talk about your deal with our audience, and even more so, what if we put our own SPV together to bring more value to our clients by lowering the tickets and getting better terms, like pulling money together. And so that's what we're here to talk about. We'll talk about more details throughout the call. And obviously Ben, who's going to lead this, is going to give every insight into anything you guys want to talk about around this deal. Some housekeeping before I hand it over to you. Just chat and Q&A are open, so feel free to ask any question, any remark that comes up throughout the call. We'll try to leave the Q&A for the end, unless there's something like super urgent or relevant for what we're talking about at the moment. And regardless of all that, this will be recorded, and we're going to share this recording, the deck, after the call. And so if questions come up afterwards, you'll have all the contact information you'll need to reach out to us or to Aspen. So that's it. Without further ado, Ben, I'm going to hand it over to you. Share your screen, do your stuff, and let's dive into it.
Perfect. Okay, I'm gonna hit the share button here. All right. Well, hello everybody, and super excited to be chatting with you all. Latan, thanks for bringing me on, and excited to share one of our latest offerings called the 51 Upstream Energy Fund VII. This is an oil and gas investment opportunity. So, might be new to some investors. This is something in an asset class we've been investing in for many years, and have really seen a lot of opportunity and continue to see a lot of opportunity. So excited to dive into that. I'm going to spend probably about 35, 40 minutes going through the framework of why there's a great opportunity in the market, the track record of past funds, and then also identify some of the case studies of past acquisitions we made in the last fund in particular. And then really want to leave some time at the end for Q&A. So Latan, we've talked a little bit before. You can jump at any point, pause me, clarify anything, ask some questions, but then we really want to open up for the everyone that's watching to ask their questions live. So my goal is to be open book, as transparent as possible, and answer any questions that you guys have related to this. I know it may be a new asset class for some people, so want to make sure people get all the questions answered. So with that, I'm going to dive right in. As always, got to give the disclaimers, right? This is just a presentation. It's not an offer for sale of any securities. You would need to review our full private placement memorandum, and it's obviously anything else that Latan puts together for the SPV that he's contemplating. We are going to talk about pro forma and projections. These are not guarantees. This is nothing that we can promise to provide. It's what we would hope to achieve based on our pro forma, but there is no guarantee. And then past performance is not necessarily indicative of future performance. So there is risk involved in investing. You got to understand that, and make sure you review all the risk factors and all the disclosures in the legal documents therein. Okay, first off, for those of you that don't know much about Aspen, you maybe heard of our name, maybe you haven't heard of our name. We've been around for about 12 years. And our two co-founders are right here, Bob Fraser and Jim Mafuccio. Bob is my father, and Jim is his co-founder. They started Aspen about 12 years ago. And a unique background. Bob actually came from a tech background, probably similar to Latan, and ran a hedge fund for a period of time, but really became an expert in economics and finance, and met Jim kind of coming out of the great financial crisis. And they saw a unique opportunity in distressed debt. And great time to get into that space, although at the time it didn't seem like a great time, right? But like most opportunities, it was kind of contrarian to what a lot of the headline narratives were and what a lot of the risks that people thought were in the market, and saw an opportunity come in at a great time and really built the foundation of our investment platform from there. And then from there, we've expanded into several other asset classes, including oil and gas investing. And all of that's being driven by what we call our macro driven investment themes. So what we're doing is always looking at the big picture macroeconomic trends that are going on in the market and position our portfolios and our investments to benefit from those trends, so that we can be in a rising tide that's going to lift all boats, right? And that's really how we have framed out a lot of our investment themes, which we'll talk about here in a minute. The other two partners of Aspen Funds are Dan Schulte, who's our COO, and myself, who is actually our Chief Investment Officer. And my background is actually in commercial banking, and I was an underwriter and a lender for several years before joining Aspen about 8 years ago, and helping lead our capital markets and investment efforts at Aspen. Dan was actually former general counsel at a large investment management firm. They had about $150 billion under management before leaving and doing private equity for over a decade before joining us. A lot of our team has background in oil and gas. Mine was working with a large midstream capital markets investment firm here locally in Kansas City. Jim actually started his career at Exxon. And then we've also partnered with Vyzer Energy. And so these are the partners that are really I'd say the brains behind the selection of the opportunities that we are identifying. And their background, Vyzer Energy, they've been around for over 40 years. The firm was started by Jeff Vyzer's father. They're real kind of what they're known for is the geological expertise. So they actually come from a geological background. They're geological engineers, geologists, and for the first part of the company's history, focused mostly on advising companies on acquisitions, dispositions, reservoir analysis, all the geological stuff that it takes a long time to understand and be good at. And then started managing funds about 20 years ago. Started their first fund and have had a great track record. So this is our second fund. We've partnered with them. We're really good on the capital market side, on the strategy side, on identifying the assets, the hedging programs, the acquisitions, et cetera. And Vyzer's team is really focused on the underwriting, the geology, managing commodity price exposure, et cetera. So this will be our second fund we've done with them. This will be the seventh fund, hence Fund VII that Vyzer has put together. They've historically only ever raised from family offices, large kind of single check writers. And so when we partnered in our last fund together with them, Fund VI, we said, hey, let's go raise alongside together. You can bring your larger check writers. We'll bring our retail investors, and we can have a larger fund to go and take advantage of the opportunities that are in the market. So already kind of mentioned this, how we identify deals. Not going to spend time there. Here's a little bit of our track record. If you don't know who we are, we've been around for 12 years. We manage over $250 million in equity of investors, over $600 million in management. And one of my favorite numbers is we've returned $65 million in investor distributions back to investors since inception. We serve over 800 investors and their families right now. Multiple asset classes, like I said. I'm going to get right into this particular opportunity, so we have plenty of time for Q&A. Okay, so oil and gas investing, if you're new to it, I'm going to describe a lot of what the kind of big picture looks like, and then get specific to our strategy. In oil and gas, I would say there's kind of a few primary ways to invest. What most people are familiar with and think of in oil and gas is I'm going to invest some capital into a drilling program, and that pooled capital alongside other investors will go to drill one or maybe a few new wells. And the hope with those new wells is that you strike oil, and you strike oil economically, where you can actually produce at a profit. If that happens, then I can make good returns. If it doesn't happen, I have a dry hole and I'm left with nothing, right? That's what most people think of when they think of oil and gas. that it still exists. There's some reasons that strategy can be a good strategy for your portfolio. The risks there are you're taking, in our opinion, a very wide potential variance of outcomes, right? And what we've seen in evaluating a lot of those types of what I call pure drilling plays, most of the time, there's a huge range of outcomes. It's all the way from zero, didn't work, to really good returns, and anywhere in between. And so our approach was, how do we take a more risk mitigated approach to investing in this asset class without the wild volatility of these wide range of outcomes? And so what we've done is focused on identifying and purchasing existing producing oil and gas assets for current cash flow. And that's in the industry called PDP. These are proven, developed, producing wells. And you can purchase those, like in real estate, you have a cap rate. There's kind of a present value metric that's similar to a cap rate. You can purchase these at a certain kind of cash flow metric. That cash flow then creates an asset that we can leverage, because many times in those producing wells, you have rights of other minerals to go do more drilling. And then we will partner with those operators that are operating those wells to participate in new drilling opportunities. And by doing that, that allows us to get exposure to new drilling, some of the upside and the benefits of doing drilling, while also having an anchor asset that's producing cash flow. So that mitigates a lot of the cash flow risk. You can also enhance the returns through the drilling. And what we're really focused on is called infill drilling versus exploratory drilling. And so what we're doing is we're participating alongside large operators called non-operated working interests, and buying an anchor asset that's cash flowing, leveraging that cash flow to do and participate in new drilling opportunities, to enhance our total return, to get some of the tax benefits of doing so, while mitigating some of that volatility and risk of that. So I'm going to talk more specifically about how that strategy plays out here in some of the example assets and case studies that we've purchased, and then what those returns will look like. Before I go any further, we have a couple of resources if you'd like to review more. We did a oil and gas masterclass with Jeff Mahajer, our partner on this fund, which was about an hour and a half. It's just 101. So what is oil and gas? What are the ways to do it? What does all these different terms mean? If you're new to this asset class, I highly recommend you watch this and spend the time to understand more about this investment class. And then we also did a more recent webinar that was just done a few weeks ago on the state of the market. So what's the opportunities in 2025 for oil and gas, right? This is a year with a new administration place that has a different energy policy than the prior administration. So how does that impact the potential for this fund? We answered all those questions in depth there. So really kind of a high level overview of the market, and you can get an update there. So just a few kind of high level points before I get into specifics. Here's some of the reasons that we think it's a good opportunity. Really first and foremost is experienced sponsorship team. This is the seventh fund that Mahajer's team has operated. This is our third energy fund that we've invested in and operate. I'll show you the track record from the other funds in a minute here. And really what we're going after, I would say, is very different than a lot of the more mom and pop drilling opportunities that you see being thrown around, for different investment opportunities. A lot of times what you mostly see show up in your box is, hey, we're taking a couple $1 million. We're going to go drill a few holes and hope that we get some oil. This is really going after what I would call institutional grade or middle market opportunities that have largely been purchased and owned by private equity or large family offices, but there's been a huge pullback of capital. I'll talk about that in a minute. In this asset class, for a lot of reasons, that's created a gap of capital and the availability of capital, and allows us to take advantage of purchasing these assets at really good values and getting access into institutional quality assets alongside large operators, most of whom are publicly traded companies, not small mom and pop operations. You get the cash flow on the upside. So our strategy again is buying existing cash flow, leveraging that cash flow into new opportunities for getting the upside total enhancement of value through that, as well as some of the tax benefits. Tax benefits, you get a lot of tax benefits in oil and gas. I'll talk about that in a minute. Contrarian theme. We think the best opportunities most times are when the market is moving one direction and the headline narratives are saying one thing when the underlying fundamentals of an asset class are saying a totally different thing that is very positive. And we think right now is a very unique buying opportunity in 2025 to purchase really quality assets at really good values, not only for, the anticipation that oil prices and gas prices may be higher in the future, but even at right now, current values, really, really strong returns. And I'll show, again, some of those assumptions here later. And then co-investment. Last fund, our team co-invest alongside LPs. We plan to do that again in this fund. We put over a significant seven-figure check, multiple seven figures into the last fund. Plan on doing that again into this fund, right alongside our LPs to show our alignment of interest. Here's a track record that I mentioned. So this is Mahajir's track record of the 6 prior funds. You can see the kind of 4 bottom ones here: Genesis, KLTG, and Lane Energy. These are all realized funds. So they are, they've gone full cycle. You can see here invested capital and what the ultimate proceeds were from those transactions at the end of the day. The multiple on invested capital, that's a simple ROI number. And then IRR is obviously time weighted. So very strong returns in the realized funds. They're currently operating 40 Energy. This is unrealized, but based on current reserves analysis, have had a very, very strong return. They bought this, right when oil was bouncing off of, some historic lows in about 5 years ago, and great timing to get back into it. And then Fund VI is the other fund that we're currently operating. This was launched about 1.5 years ago, and have already created an unrealized IRR of about 36% based on current reserve analysis from the current cash flow that we're generating and the drilling that we've participated in. Here's just a little snapshot of some of the assets that Mahajir has owned and operated over the years. And here's some just little by the numbers for our Fund VI, which was basically the exact same strategy. So very, very similar strategy fund relative to this fund. We raised 41 million in equity. We have made 3 large acquisitions to date, are participating and have ownership in 183 producing wells. We've already participated in 5 drilling projects. Like I said, a 36% unrealized estimated IRR based on current reserve analysis. And we're currently cash flowing. We're paying out distributions in cash in 2024 between 15.1 and 17.7%, depending on the investment amount. So higher amounts receive better economics. And so our lowest share class is still receiving a 15% cash on cash return. And one thing I wanted to make a point of, I forgot to mention earlier, on the drilling projects, one of the benefits of this, if you purchase a non-operated working interest, you get, in this case, these 3 acquisitions, ownership in 183 wells. We are a small percent owner of all those wells alongside these large operators. And then what happens is these are operators, we have, I believe, 8 different operators in these 883 wells. They will propose new drilling opportunities. We have, as a non-operated working interest owner, the ability to participate in those drilling programs, but not a requirement. And so this allows us to be hyper selective in comparing and contrasting a lot of different opportunities, a lot of the geology, understanding the track record of that particular operator in that particular basin, in that particular area, to really be very selective in what we believe are the best opportunities in drilling to layer into that. So there's not a requirement, but a right to participate if we so choose. So this particular fund, our target fund size is $100 million. Our stated minimum in Aspen is $150,000. Latan has negotiated to reduce his minimum of his SPV to $50,000, and we'll show kind of a compare and contrast of what you get working with Vyzer in this fund versus coming direct to us. Our waterfall is a 70-30 LPGP profit split. Our projected hold period is longer than some funds you may have seen. We have a projected hold period of 10 years. We don't anticipate holding for the full 10 years. And if you actually go back to the track record a few slides prior, the average hold period is about 2.5 years across the six funds. Now, some of those are longer, some of those are shorter. But the idea is we want to have enough time to realize our investment thesis, which I'll share here in a minute of the whole macro picture going on. But we're also going to be opportunistic when the market is rewarding the participants for that investment thesis as it comes out to play. So we have the ability to hold for 10 years. We don't anticipate holding that long, but it is a longer hold period than some people are used to. Though again, past track record has been much lower than that. We're targeting at our kind of base level kind of share class of 150K minimum, 25 to 30% IRR. If we hold for the whole 10-year time period, a 4 to 7x multiple on invested capital or equity multiple. We'll make distributions quarterly once we start distributions, and anticipate about 25 to 30% leverage because we purchase producing assets. We can leverage some of that cash flow for a little bit cheaper capital, and also the ability to have a line of credit to go purchase new assets and or do drilling. And then we also will employ a commodity price hedging program that will soften a lot of the volatility you might have in other funds that are just running at market, right? We want to have some commodity price hedging where we can lock in the sales price at some of our production for the future, so that we have confidence in our operations and being able to continue to make distributions. Even if prices go down over time, we're going to have a portion of our production that's always hedged.
I have a question about that, Ben, for a sec. The
Yep.
hedging, is that Aspen doing the hedging, or is it Mohajir doing the hedging?
It's joint. We have to jointly agree on all hedging programs, so it's a unanimous vote. But what we generally do, it's a pretty simple strategy. We're putting in place costless collars. So we basically have puts and calls that have a range of where the price can kind of float in between, and then if it hits one of those thresholds above or below, we are limited to that number. So it limits some of the upside, right? But it still usually has a nice range to get up to. But the real help is it limits the downside as well. And again, we don't hedge all the production. It's usually less than 50%. So we still can ride the market as we believe prices will go up over time. But yeah, we don't control the market, so we want to have some of that downside risk protection.
Right. All right, thanks.
The way the structure of the fund, we're going to be raising capital and deploying that capital for 1 year. So we just launched the fund a few weeks ago. We've already got an incredible amount of commitments coming in, and anticipate the capital raise period to be on the shorter end. And then the deployment period will be deploying that capital simultaneous with raising the capital. We have several assets that we're looking at right now. We don't have anything under contract. We're pretty close on one, which we'll obviously share as those get closer. And the first year of the fund, this is a kind of important point. We're going to be again focusing on a producing cash flowing asset. And then the first year, we anticipate 100% of the profits of that asset will be reinvested back into new drilling to compound returns. So we target distributions starting in year 2, and then thereafter growing over the life of the fund. So the idea is we're going in and buying cash flow. We're then leveraging that cash flow into new drilling to create a compound effect to increase total return for the fund, also in balance with current cash flow and distributions for investors, similar to the last fund that I showed you. So here's how our fund is set up. We have different share classes based on different minimums. If you come to us, the lowest investment you can make with us is $150,000. And in this case, we've had several conversations with Latan, and he is shooting to hit $1 million through his SPV, if not more. And by doing that, we're going to grant his SPV, Vyzer's SPV, a 15% share price discount. So what that effectively does is allows that fund to buy more shares of the fund and thereby share in a greater portion of the profits. So that will increase the net IRR and the net annual return to that fund because of the higher pooled capital coming from the fund. So Latan has a little side by side he'll show you here in a sec that will show what the returns look like investing through his SPV versus investing with us. Let's talk a little bit about talked about all these things. Let's talk about some key risks and mitigants. So in oil and gas, if you're new to the space again, there's a lot of other things that you have to think about and understand as risks that you may not be familiar with if you've only ever invested in private equity or real estate. And I've identified what I say kind of four of the key main risks are here and how we have approached those and tried to mitigate a lot of those risks. The first is operator risk. And in probably more than any other asset class that I've seen, operator risk is probably the biggest risk because what I've seen a lot promoted out in the capital raising ecosystem is small mom and pop operations, raising a couple $1 million to go drill a few wells. These are, the wildcatters, the, boots on the ground kind of cowboys that are hoping they hit oil. And some of those work out well, but some of them don't. And we've also honestly seen a lot of borderline bad actors, people that at a minimum are being, I would say, highly exaggeratory or deceptive in what they say they can do or can do. In some cases, we've seen a markup on drilling programs of 100 to 200% of costs. And for example, say it costs $1 million to drill a vertical well, they're raising $2 or $3 million to basically buy into that well. So they're having a ton of markup that's basically, going straight to the operator's pocket. So there's just a lot of things you really want to understand is who's the operator. And in this case, when we're focusing on non-operated working interests, meaning we are not the operator, but we're participating in the working interest, which means we get the tax benefits, which means we get the upside of the drilling. And we're investing alongside large operators, very experienced middle and large market operators in proven basins. And so I have a list of some of the operators we've worked with already, but most of them are publicly traded companies, multi-billion-dollar firms, well capitalized, great track record, et cetera. The other big one is drilling, right? And so most opportunities you see are drilling opportunities that are hoping you hit oil and hit oil economically. But with that comes a very, very wide variance of potential outcomes. And so what our focus is, buy cash flow, leverage that cash flow into infill drilling opportunities versus wildcat or exploratory. Because what happens is the infill drilling is very different than exploratory. Because you're drilling in areas that have very well proven geology. The geology is well known. Instead of going and drilling into a new basin, into a new area, this is the 100th or 1,000th well that's been drilled in this area. You have a very high level of confidence of what you can expect. In the case of some of the other assets that we've invested in the other fund, the infill drilling has full cycle IRRs in excess of 50%, including those that are uneconomical. So you have a pretty high likelihood of success in these types of drilling opportunities versus let's go try and find a new area and see how that goes. The other kind of thing to think about here, I don't have a ton of time to spend on this. We spent a lot of time on it in the 101 masterclass, but there's a big difference between vertical wells and horizontal wells. What most people are drilling are vertical wells, right? Those are the things that with the arms that you see on the side of the road, they're going up and down and just, pumping up the oil. When you drill those, you just go straight down. And that's kind of been the technology for a very long time. It still works. The challenge is you pick a spot and you hope that you find the right spot because you only have one direction you're going. The technology has really massively improved over the past several decades to now have horizontal drilling to where they're much more expensive, much bigger operators generally. But you can start vertical and then you can find the basins, find the reservoirs, and then you can curve into going horizontal and sometimes go horizontal for many miles. And so horizontal drilling massively increases your likelihood of hitting oil because you can go and find the basins effectively and go further into them and go up to 2 to 3 miles sometimes. And the the great thing with that is you can participate alongside them. The challenge to get access is sometimes one horizontal well can cost anywhere from 10 up to $20 million for one well, right? So by participating in these as a small owner, we can have access and exposure to some of these, great infill wells with a very small check because of our or smaller check, I should say, because of our interest in the working interest. Environmental risks, you hear about oil spills and other environmental issues. 95% plus of those issues are generally offshore drilling. There's very few negative environmental incidents in the lower 48 states, but that is part of the due diligence process, and reviewing operators' insurance coverage is a key part of the diligence process. And then the other big risk here is commodity prices. This is something we don't control. This is a global commodity, oil is at least, and part of the way we're mitigating that, like I said, is through the partial hedging. Okay, I'm going to kind of fly through the rest of these charts because I'm going too slow at times, so I apologize here. But some of the big trends going on are green energy, right? And this is what's causing a lot of the capital to pull out of fossil fuel exploration. This chart is pretty surprising to a lot of people, myself included, when I first saw it a few years ago, because what most people think is that we're much farther along in the green energy transition than we actually are. And so if you look here, that kind of big blue circle, that's all fuels that is supporting our global energy usage. Right now, it's 83% carbon-based fuels. Only 17% of the energy that we use comes from non-carbon, hydro, wind, nuclear, and solar. And we've been investing in these technologies for over 50 years, and we've only made a dent into 17%. Now, that's going to keep increasing, but we're a long ways from fully replacing fossil fuels and fully going green. And what's happened is these kind of headline narratives are basically saying fossil fuels are irrelevant. We don't need them anymore. We're close to this transition, and all the kind of big energy initiatives and benchmarks are saying we're very close to transition. The reality is we're not. And so, one of the things we're looking at is what are the smart investors doing, and what are the big money doing that's maybe different than what the headline narratives are saying. And this is an article from just a few weeks ago. Warren Buffett has made a huge bet. He's been investing in oil and gas for many years, actually. He just made a $400 million bet in Occidental Petroleum, which is a upstream energy company, and sees a lot of opportunity there. Here's some things going on with the supply and demand side, right? Because what's really interesting about oil is it is a limited resource, and it's a depleting resource, right? It's very different than like real estate, where it's a naturally appreciating asset over time. Oil is a naturally depleting asset over time, meaning the more that you produce out of the ground, the less there is in reserves in your reservoir. And every year, we deplete anywhere between 2 to 5% of our current production just through depletion, just through producing it. So it requires a amount of continual capital expenditure into new exploration just to maintain kind of current levels of production, not to speak of potential increases in demand and needed production. And so you can see here on this chart, this shows the investment in oil and gas exploration development over the past several years, and it's decreased by over 55% over the past 10 years. And so it really spells a future a supply issue, right? Because oil and gas production and development, it's a long process. You can't all of a sudden just flip a switch and massively increase supply all of a sudden. It's a long process of permitting, exploring, getting the capital, getting the drilling done, building the midstream and the pipeline and the transportation to get it to the consumers. These are things that take a long time, and you can somewhat forecast what the future supply is going to be based on the things we're doing right now. Like I said, because of the ESG initiatives, because of the green energy kind of narratives, ESG is environmental societal governance standards that are being imposed on capital allocators that are requiring them to hit certain green energy standards, right? And again, this is nothing against green. I'm all for being more green. I think most people want that. The challenge is the standards are really unrealistic, and it's forcing capital to be allocated to places that are, in our opinion, creating a big gap and misconception of what we actually need for energy consumption. And so you can see here, this is capital being invested from private equity into oil and gas, and it's dropped substantially. And what that's done is actually create a huge buying opportunity. We can buy some of these assets at great discounts. I'm gonna skip some of these because they're a little more technical. Though they are beautiful charts. I'm gonna go to these. The simple supply and demand. So this is from Exxon, and this shows, if you can see here on these charts, a little bit small, but the black line here is demand. And this is oil, and this is natural gas. This is projected demand. This is kind of basically projected to stay the same. Most estimates, even the most green, leaning energy agencies are predicting that demand is not going down for oil in the next 10 to 15 years. I would agree that it's likely going to continue to go up as we have higher demand from population growth and GDP growth. But let's just say it stays constant. Because of the lack of new development happening and the investment in the exploration, this is what production is expected to do if we just invest in existing fields. If we don't invest in the existing fields, just current supply, this is how quickly the decline curve is gonna hit here by 2050. And so you can see there's a huge gap here between supply and demand if there is no new drilling happening outside of current existing fields. Same thing with natural gas. This is a chart from JP Morgan, and they're saying the same thing. This is in a shorter time period. This goes all the way out to 2050. This is just by 2030, 5 years from now. They're estimating a potential supply deficit by 2025, by 2030 of 7.1 million barrels per day of oil, right? Because demand is at least going to remain steady, if not increase. In supply, it's a depleting resource. So there's a pretty big gap, right? So that puts a lot of pressure, and what we believe an upward pressure on prices over time. And so we think it's a great time right now to be buying where prices are, they're strong, but they're not, wildly outside of normal ranges. And we could also buy these at really good values because of the lack of available capital in the market. So our kind of prediction for oil prices in the near term, we call it range bound, meaning the demand side, the U.S. is strong because of our GDP growth. China and Europe, it's a little bit weaker demand because their economies are struggling a little bit. So it's kind of kept the demand side a little more in balance, in equilibrium. The supply side, though, long term is constrained. There's limited drilling and depletion. And so what we think right now in the next year or so is going to be a great time to buy because prices are kind of in this range and counter to long-term trends where we think prices are going over time. So I'm going to share a couple of the assets that we purchased, then we'll go to questions here in a sec. So this is an asset that we purchased in the Scoop Stack, which is a very large basin that crosses between Oklahoma and Texas. And the great thing with this asset, it was a great story because the private equity firm that was selling it, this was one of the last assets in their fund. They are actually a operator of a lot of other assets. These were kind of the last assets they owned that were non-operated working interests, right? That's our strategy. But that wasn't their strategy because they are actually operators and they wanted to, they had other opportunities that they were drilling, that they were operating, and they wanted to dispose of these assets so they could reallocate that capital. And because it was, end of their fund life, they had to kind of clear the funds assets. They sold it at a pretty incredible price. We picked this up as a $30.5 million purchase that gave us ownership into 140 what's called gross wells. Our net ownership is much, much smaller than that. And this was producing at acquisition $8.7 million of cash flow a year. We bought this at about a 23% net present value on that current cash flow, including all the decline curves built in. So that's effectively the same as a cap rate in real estate, right? Over 20% cash on cash, unlevered yield that we would expect just from the existing production. The great thing with this is there was also 68 potential development drilling locations that were already identified that we did not have to pay for in the price. And I've already started participating in some of those. And so that's going to continue to increase that overall cash flow, increase our overall value over time as we do that. And this also was producing multiple types of commodities, which we really like diversification, not only with operators, with the region that we're in, but also in the types of commodities that we're producing. So in this case, we're producing oil, we're producing natural gas, we're also producing natural gas liquids. Asset number two, this is
Ben, sorry to interrupt. I think so there are a bunch of questions and these case studies are important. Do you think we should sort of like skip the Q&A or are these like, what do you think? There's just a bunch of questions. I want to make sure we answer them.
Yeah, I think let's go to questions just real quick. Here's a picture I mentioned. Some of the operating partners that we've worked with in these other acquisitions. Most of these are all publicly traded companies, names that a lot of people would recognize. And then the returns, we'll just show this real quick because I think this is helpful to kind of see what it looks like. Then we'll get to questions. So this is based on a $250,000 investment. And the key assumptions here, right, this is over a 10-year time frame, but oil prices at $75 flat, kind of roughly where it's at right now. Natural gas price at $3.50 flat, roughly where it's at right now. Reinvestment, like I said, that first year and continually into new drilling projects, and then a terminal value when we sell the assets that are cash flowing to the next buyer of $35,000 per flowing barrel is BOE equivalent, is a barrel of oil equivalent. That's kind of a valuation metric. So you can see here, based on these assumptions, is showing a 31% IRR, an 8.8 equity multiple, and cash on cash average of close to 30%. Here's a downside case, right? Because the challenge here in oil and gas is there's a lot of assumptions you have to make, and so we want to kind of create a range of what potential outcomes could be. And the assumptions here are $60 oil flat over an entire 10-year period, natural gas price of $2.50 flat over a 10-year period, and also participation in about 50% less development or drilling, which creates a lot of that upside through reinvestment into drilling, and then a lower terminal value of about by 30% or so, a lower terminal value on exit. And you can see here in our downside case, IRR of about 12%, equity multiple about 2x. This is over 10 years. So not terrible, but definitely not what we would hope for or expect in that. So let's go to Q&A.
All right, why don't we start? Because Chris has a question like pretty much at the beginning in the chat. What percentage is the GP investment to the overall fund size?
Yeah, so we haven't identified exactly what that number is going to be for this fund. In the last fund, we invested over 15% of the equity in Fund VI.
And if we're already talking about the previous funds, what quartile were they in?
I mean, we don't benchmark against like Morningstar or anything else. So these are private market funds, but I mean, I don't see a lot of funds producing the level of IRRs that we are. So it's probably top quartile, though. That's me guessing without knowing what benchmarks you're talking about.
All right. Thanks. Now going back to the Q&A. So You see it, right? The anonymous number one in 1236, the understanding about the tax
Yeah.
advantages.
Yeah.
All right. You want to touch on
Yeah.
that?
Great. Great. I'll jump on that. Great question. And this is a very, very common question because, as I said earlier, what most people see in oil and gas are drilling opportunities. And what they do a lot of times is we'll accelerate some of those costs kind of into that first calendar year, the drilling costs. And you can take those against your income, right? You can have kind of like bonus depreciation or accelerated depreciation. You can accelerate in real estate. You can also do something similar in oil and gas. And then if you enter that investment as a general partner, you can potentially take those losses against active or earned income, right? So it's a great benefit from a tax standpoint. This fund is not designed for that, right? So as I said, those funds can have a purpose. It's great to get a tax benefit, but it's always important to never let the tax benefit tail wag the investment dog, so to speak, right? I think it's been promoted so much because people love the idea of that, but it misses the point of the whole point of the investment is to make money, not to just get a tax write-off. Because if you end up not producing oil or hitting dry holes or producing economically, you're going to have a even greater tax benefit of a capital loss that you can roll forward, right? But no one wants that. That's not the goal. We're not investing to just get tax benefits. So, not to say you shouldn't do those, but you got to understand the trade-offs there. The focus of our fund, like I said at the beginning, is total return. We want to maximize shareholder return and do that as tax efficiently as possible. So what we're doing, because we're buying existing cash flow, there's cash flow coming out of the ground day one when we purchase that asset. That's going to be producing a cash flow that will have a tax consequence. And so our goal is to offset as much of that taxable income from the fund through the tax losses that we generate from the new drilling and from natural depletion expense. And so we anticipate that the fund will not produce tax losses in excess of the income being generated of the fund, but would hopefully shield and shelter a lot of the income coming from the fund to the limited partners from their tax liability. So we don't anticipate it may shield all the taxable liability from the fund. It may not, depending on how much drilling we're doing in a given year. At a minimum, it's gonna shield some of the tax liability that you have from the income from the fund.
Before we talking about taxes, there's a question from Kirby about UBIT, how to avoid it. Is that sort of possible,
Yep.
or how does that work?
It's possible because we are anticipating using some leverage in the fund. UBIT is an obvious thing that could happen. I think it's something that you got to weigh, kind of the risk, or kind of pro and con. Because one, I'm not an expert in tax or UBIT, but from my understanding, some limitations on there's a minimum level of UBIT you have to generate before you even incur that consequence. I think those rules have changed in the past few years. The other thing is, especially if you have like a Roth IRA or something that is gonna, compound tax free, um, maximizing total return can be a really, really big thing to consider because that's a, a great way to get some of that outsized return tax free or tax deferred. Again, you got to weigh that kind of pro and con. It's going to be a small amount of UBIT, if any, because our leverage point's likely going to be 25% or less. We don't anticipate using more leverage than that. So real estate, obviously, you're usually in the 70 to 80% leverage range. So it's usually has a lot more UBIT. This is going to have less, if any.
The minimum is only 1,000 of income from leverage. That's what Kirby's writing here. I don't know if that helps or makes sense.
There you go. Yeah. So I think that's
Um,
a great point.
just one more thing on taxes, that we'll go back to sort of the other deal structure. So any plan for offshore blocker corp? I don't know if that's a question for you or for us when we put the SPV up, but I don't know if you want to take that first. I don't think you guys are setting up a blocker corporation for this.
No, I mean we've done UBIT blockers before in other funds. We're not going to do that for this fund. And I don't know what other kind of offshore blocker you would do if that maybe blocks against federal taxes. But again, the tax losses that we generate from the drilling and then the natural depletion schedules that you have on the existing cash flow should shield a lot of the taxable income that you get from this fund. And the great thing with oil and gas, especially in hedgeable drilling costs, is there is no recapture like there is a depreciation in real estate. So it is a true, real kind of tax shield. But we're not going to do any blocker. I
All
don't know
right.
if you plan on that, Laton.
Yeah. Okay. So we're not, no, we're doing a Delaware SPV flow through entity, and we'll talk about that in a sec. Um, so then there's some more, questions here about leaving money on the table. These like 20 years. If
Yeah, let me read it. So wells could potentially produce oil for over 20 years, the less over time, with the fund exiting within 2 years on average, or even after a full 10 years, I'm leaving money behind. Great question. The idea is we want to buy the production at a lower value than we're going to be selling, right? So just like in real estate, if you sell real estate, if it's cash flowing, you're also leaving money on the table, but you're not going to realize, some of the improvement in that net operating income that you generated. So it's the same concept. Yes, we're leaving money on the table, but what we're doing is selling it at a future discounted rate that we get all the cash now at that discount rate, and the next buyer takes that risk to hold it for that. So if we can buy something for a 20 or 25 present value in PV, but we can sell it for a 10 to 15% present value, even if we haven't increased production at all, that's a huge increase in value that we've been able to achieve just by timing the market well. And those numbers sound kind of crazy from swings in valuation, but in oil and gas, that happens all the time. There's huge swings in valuation. So timing of purchasing and disposition really matter, and that's where you can create a lot of delta in your value, because the next buyer is actually maybe willing to pay a lot more for the same cash flow than a buyer would have a couple of years ago. And so the idea is we want to increase value from increasing production by the drilling. Obviously, we're having some depletion, like you said, but we want to kind of beat the depletion curve through new drilling. And then we also are expecting that valuations would increase on a per barrel value because of the potential expected price pressures that might come in the next few years, where a lot more capital is going to realize, oh, wow, we need more fossil fuels. We need to reinvest back in this, and more capital is coming back, driving up valuations.
Okay. And then the next three questions are all about distributions. Before diving in, I'm just going to share, just because I want to make sure we have this, in front of everyone as well. Just I'm going to share my screen a sec. I'm going to steal yours. All right.
Yeah, please.
So just to share some context of the SPV we're putting together to invest in this deal. So yeah, as Ben shared, there's a 150 minimum ticket to invest directly in Aspen. We're putting together the SPV so that people can invest with a lower minimum of 50. And obviously, if you invest direct and you want the 15% discount, you have to invest a minimum of $1 million ticket. And we're going to pull it together, and for sure, past $1 million, and we're going to reach that. So essentially, you're going to invest 50,000 and get 15% discount on that 50,000. That's just like in terms of like the differences between direct and through the SPV. We are charging a management fee for the SPV. It'll be a 2% base management fee, but we discount that based on the tiers you are on Vyzer. So if you're on our highest tier, for example, and our elite plan, there's no management fee, and then all the way down to the other tiers are discounted. But even taking the highest into account, the 2% management fee into account, these would be the differences in returns over the 10-year period of the investment. So directly, it's 150,000. You don't get the 15% because you're putting 150,000. The base case scenario that Ben was talking about is almost $1.5 million after 10 years at 31% IRR. And the downside is 450. And then let's just say, take the same example of a $150,000 investment through the SPV. There's substantially more cash flow just because of the 15% increase or discount in NAV. And so I just wanted to share that for a sec, just to make sure you guys get that understanding. We're not recommending this at all. We're not investment advisors, but we do believe this is a good opportunity. That's what we think. We just want to make it more accessible to people. And I just wanted to share that so you guys have that in front of you as well. And I ran really quickly fast through that, but it's going to be recorded so you can just watch it at lower speed. Just like to ending this up, Ben, these three questions about distributions.
Yeah, these are great questions. So First one, distribution will fluctuate based on production of wells. Typically, larger distributions occur when it first starts to produce and get low over time. Is that what investors in the fund should expect from the quarterly distributions? Um, yes and no. So when we're buying existing cash flowing wells, we're generally buying them after the significant declines of the initial production, right? So it's more on a stabilized kind of natural decline curve of that kind of 2 to 5%. So that cash flow is not going to wildly change. The other kind of cash flow that we would generate from new drilling opportunities would have some of that initial production and then kind of stabilize out at lower decline curves. But we anticipate, if you look at our pro forma, and I apologize, I didn't have time to go into it a whole lot, but what we're doing again is we're not distributing 100% of the cash flow that we're generating because we want to continue to reserve and reinvest back into new drilling over the entire investment hold period, because that's what ultimately drives long-term value and that kind of long-term cash flow and terminal value. And so what we do is actually target a distribution percentage on invested capital every year. And if you look at our pro forma, the target yield actually increases every year. And that's because we anticipate being able to grow our production, grow our cash flow. And then the other kind of thing that's going to soften some of the volatility potentially is our hedging, right? So we're hedging a good portion of our commodity prices. So we have some stability and predictability of what we anticipate distributions to be. So like I said in our last fund, last year, we're paying out 15 to 17% quarterly distributions. That's remained steady. That's been steady every quarter. We're actually anticipating that increasing here shortly as we are participating in new drilling. We get some of that additional cash flow over time. And so that's going to likely continue to increase. There is no ability to reinvest distributions because this is a closed-end fund. It's got a defined hold period, defined kind of reinvestment and distribution period. So we can't reinvest those earnings. Are the distributions paid out quarterly starting in year 2 after all the capital has been deployed and raised? If so, distributions are taxed to investors at ordinary income rates. Is that accurate? So the distributions, like I said, you nailed it there. We're anticipating them starting in year 2, after we've kind of purchased the first assets and kind of done some of the drilling participation. We actually accelerated our distribution schedule in Fund VI because we bought them at such great present values and there wasn't as much drilling going on in that particular time period. So we accelerated that start date. So it's possible we could do that, but we want to set the expectation that, don't expect distributions for kind of the first kind of time period there. Yes, they would be taxed at whatever your personal rates are. They would generally be considered ordinary income. But again, a lot of that income will be sheltered from the tax losses that are going to directly offset that income. So we don't anticipate, all that income to have a full tax liability in 2023. We haven't done 2024 taxes yet. All the income that was generated from Fund VI was offset by the tax losses. Now, we purchased our first asset in the middle of 2023, so we didn't have a full year of income being generated, but even still, it sheltered most of the income. So our investors did not have any tax liability from that income. Can we get several years of redacted K1s from a similar fund? Yeah, if you reach out to us or reach out to Latan.
Yeah, we'll take care of that offline. And the last question is really important, I guess, for people. And
yeah,
I know you have to skip. Let's answer that really quickly.
Yeah, have we ever paused distributions or lost investor principal? In our oil and gas funds, we have not paused distributions or ever lost investor principal. In some of our real estate funds, as a lot of people have experienced, we've had to pause distributions on a couple, but we're actually resuming distributions on several of them this year, and we've never lost an investor principal. What kind of tax documents do you provide? This would be a single K1.
Right, and just to emphasize that you receive it in the summer. Not at the
yes. Thank you for saying that. So there's one thing. If you have investment in oil and gas, you have to understand that you will need to file an extension on your tax return. Because of all of the underlying constituents of this fund and the operating partners that we have, we cannot feasibly get the tax K1 out until the summer. And so you'd have to expect and be okay with a late filing though most of our investors do that anyway, but just want to be really clear on that so there's no surprises.
Ben, I know you have to skip. Thank you so much. This has been super interesting. And as I mentioned, we'll share all the contact details for Ben and his team, as well as this recording and their deck. And if you have any questions, feel free to reach out to us. And thank you so much for joining us. Till next time, keep investing wisely, everyone. We'll be in touch.